Good morning, everyone. I'm going to stay on a familiar theme of market volatility, which seems to be the buzzword of this year. And in particular, I'll be looking at high inflation and increases in government bond yields. So building on the themes that Paul has introduced us to really today. So 2022 has seen discussion of a different peak. We've been talking about COVID peaks for quite some time, but 2022 has started a discussion around inflationary peaks. When will inflation peak? At what level will it peak and how long will it last for has been the questions we've been asking ourselves. And you can see from the chart here that inflation over the last sort of 5 or 6 years has been oscillating around that Bank of England target of 2%. It's been pretty steady and pretty predictable for a while now. And really over 2022, driven by Russia and other factors, inflation has really spiked up, as we all have heard about, resulting in sort of inflation, CPI, annual inflation to September 22 of 10.1%. And that's a really important metric in pension schemes because it's used for deferred revaluation, it's used for the triple lock, for example, and other pension increases in occupational schemes. And inflation actually peaked higher than that last month at 11.1%, meaning that the pain isn't over. But as you can see here, the Bank of England forecast, as Paul was saying, that inflation will come down pretty rapidly now over next year. And this spike in inflation is expected to be at least relatively temporary. Actuaries are still assuming, or are assuming as at today, that inflation measured by CPI will be about 3% over the long term still. And we talk about these headline rates of inflation, 10, 11%, a lot at client meetings, and we hear it in the press. But we don't hear quite so much about how inflation's segregated into the different basket of goods. And you see on the last but one point there, food and drink inflation has been 16% over the year. And to sort of go into more granular detail around that, inflation around milk was about 50%. Inflation around pasta for the year to October was 30%. And these are the items that everybody's buying, and these are the items and the drivers behind, especially the lower income families, needing to purchase them, meaning that they're going to feel the cost of living squeeze more than sort of an average typical family buying the average typical basket of goods. And I'll come on to that in a second. So how does this high inflation feed into our benefit calculations? And that's really what I'm going to present that's slightly different to what Paul was talking about. How do these factors feed into our pension schemes in practice? So that rate of 10% will be used for deferred revaluation going into next year. So if you're a member who's retiring from 2023 onwards, you'll have that 10% inflationary figure baked into your benefits, most likely. And that's because there is a cap on deferred revaluation, but that's applied over the duration of a member's deferment period. And because of the several years that we saw of inflation being below that cap, usually sort of 5% or so, it means there's enough years of unused inflation to be built into next year. So the takeaway really is that deferred members will probably see the whole of that 10% increase baked into their benefits. And that's not the case for actives or pensioner members who most likely will see inflationary increases capped year on year at sort of 5% or 2.5%. So in real terms, that category of member will probably lose out. There were lifetime allowance and annual allowance implications, which you could spend a whole session talking on. But I have drawn out one interesting sort of nuance of the lifetime allowance in a later slide that I'll go through in a second. And as I said there, the triple lock, so state pensions will increase from April by 10% too. And I think trustees and clients need to think about the effect that will have to their pension scheme, how members' expectations will have changed, because the theme in the press has been fairness to pensioners, and particularly older pensioners who don't have another source of income. The backlash that the government potentially was going to receive by not honouring the triple lock was obviously too scary and put them off that course of action, leading to a 10% increase from April. And perhaps trustees need to be thinking about that with their scheme. You know, are members expecting those sorts of inflationary increases? Because a number of schemes will either pay no increases, perhaps pre-97 accrual, or those increases will be capped for post-97 accrual, and the resulting increase to a typical member might be much less, or will be much less, I would have thought, than the 10%, perhaps more like 2, 3, 4%, depending on your actual membership and scheme structure. Another interesting development, I suppose, from this temporary spike in inflation this year that we've seen is around early retirements, and especially early retirements now for the remainder of 2022. I said that this 10% high inflation figure will be baked into deferred revaluation come next year, but we've had members asked to retire this year, and when you retire in 2022, you don't get the benefit of that 10% increase. And so there's been a thought there and a lot of communication from trustees and clients around, well, do we need to educate members in this? Because 10% of, or a loss of 10% on a £10,000 a year pension is £1,000 a year payable for the rest of that member's life, and is very significant in the overall, decision of whether to retire now or perhaps just delay a couple of months and have a completely different benefit entitlement. What we're seeing in reaction to that is trustees communicating that to members and letting them know that they should probably be taking financial advice if they want to retire this year. And we're also seeing actuaries giving advice that if you have a scheme that has a lot of early retirement activity and the trustees want to continue honouring early retirements this year, then they've commissioned actuarial advice to provide them with temporary early retirement factors which allow for this high 10% inflationary measure, because typically without any work on those early retirement factors, that very high inflationary measure won't be baked in. And there are problems that are around setting up benefits on those factors. So Paul touched upon it a bit, but inflation and funding levels, how has this affected things? Well, a high spike in inflation, as we saw a second ago, meant that high inflation is now baked into benefits to lesser degrees with pensioners and actives, but it is baked into future benefit entitlements. And that will, of course, increase costs for trustees and employers. On top of that, of course, we've seen a rise in long-term inflation rates as well. So you can see this chart provides what the market thinks RPI over the long term will be. And in sort of September 19, it was running at about 3.5%. And that's risen slightly to more like 3.8% or so. So there'll be an increase in scheme funding relating to future inflation as well. But why those blue lines are there is to show you the maximum and minimums that we've seen over that period. So if you were the unlucky one that's measuring your funding level between the high and the low, you might see that your long-term inflation rates increased by 1% or so, which might damage your funding level. But as Paul alluded to earlier on, there's a lot more going on in financial markets that will drive your funding level most likely, and for many schemes, the losses that we've seen from the increase in RPI and CPI will probably be offset by gains elsewhere in the gilt markets. I put this slide in because I just thought it was interesting more than anything else. So this chart gives you the level of the lifetime allowance since it was introduced in 2006. So the lifetime allowance is the total value of your tax-free pension that you can build up over a lifetime. If you go over the lifetime allowance as a member, then you have to pay tax at the outset. And we can see that it's been as high as 1.8 million in the past. It came down as the Treasury wanted to generate more tax receipts. And in 2018, the LTA went down very low to £1 million, and it became index linked, so it goes up in line with CPI every year. But in 2020, the government needed to generate more tax receipts because of the COVID crisis, and it froze the LTA from that point onwards, and that's continued to be the case and will continue to be the case until at least the 25-26 tax year. So you can see the solid line is what the LTA will be over the next few years, and the dotted line is what the LTA would have been had the inflation protection been borne out in practice, as was promised a number of years ago. And the graph shows you that In 25-26, the lifetime allowance is expected to be £250,000 lower than it would have been, and that means for a member with benefit value of 1.3 million and above, which sounds a lot, but with DB accrual and with a long period of contributing pension scheme membership, it is achievable for middle to high earners, certainly. If you're in that position, you might be lumbered with an extra tax bill of £140,000. That is hugely significant in terms of your overall pension scheme accrual. So I've labelled this tax hikes. What tax hikes? And that's because the government has almost famously said, well, we're not increasing taxes, we're just freezing the limits. And that's the impact of it. Okay, you're not increasing taxes, but I'm still paying £140,000 more in tax. And that's been rolled out across a lot of the tax system. And then this idea of the cost of living and how inflation has obviously hit the pockets of many, felt mostly by the most vulnerable and the lower income families. How do we think that's going to translate into the pension scheme universe? Well, I suppose the obvious conclusion to draw is opt-outs. So whether you're a defined contribution scheme with an auto-enrolment type arrangement, or whether you have got a legacy defined benefit scheme that you're still providing to your staff, I suppose the natural conclusion from the cost of living crisis is that members will prioritise living today over saving for tomorrow through a pension scheme, and will start to opt out. Now, there's conflicting reports in the press. Different studies tell you different things. I've heard that opt-outs are on the rise in some areas, and then auto-enrolment vehicles haven't seen many opt-outs so far, but I think we're still very early into this cost of living crisis. And I fail to be able to see a world where the cost of the bare essentials goes up so dramatically and pension scheme membership doesn't come down. I just can't see that transpiring at all. So I suppose it's important for employers and trustees to try and communicate that to their staff. And different schemes will have different structures, but if you've got a defined contribution scheme, for instance, then educated members that it's not an all or nothing arrangement. You could reduce your contribution rate levels and still stay a part of the pension scheme, keeping your death in service cover, which is usually bundled in with your pension scheme, and still buying units of investments which will grow with investment returns until retirement. And there's other things that you can do as well. So if you're in a defined contribution scheme, one of the great benefits of that is you can flex your contributions at will. It's not an all or nothing. That's not necessarily the case for defined benefit schemes, which more commonly are you either pay this rate or you don't pay a rate. But there are schemes out there with some flexibilities. The LGPS is a good example where you can go into the 50-50 section, which is where you contribute only 50% of the usual rate of contribution in exchange for building up half of your benefit accrual going forward, which is a much better position to be in for an individual than coming out completely. And again, all these things should be communicated to staff and members so that they're aware. Salary sacrifice is another good way of potentially boosting take-home pay for employees for little to no outgo for the employer. In fact, saving the employer money over the medium term. And pension scams, yes. No presentation about pensions would be complete without a slide and a reference to pension scams, particularly at a time where the cost of living is so high and families are struggling. They'll be wanting to get hold of cash, and pension scammers will be all too aware of that and will target families accordingly. So very important to continue putting the pension scam leaflets in your communications and referring to it in your newsletters and all the rest of it. Okay. And then we'll go on to, government bond yields. So as Paul has been saying, yes, we've obviously seen quite an interesting time for government bond markets, and yields have spiked up quite dramatically over recent times. So I wanted to try and draw a picture of how government bond yields have been moving over recent times, and I chose recent times to be between World Cups. So we start off at the Russia, that's the date of the World Cup final in Russia, 15th of July 2018, which seems like a hell of a long time ago now. And so you could conclude that the final in Qatar should have been the 15th of July 22, but of course that was delayed. But if you look over that period, generally speaking, yields have been low and relatively stable, oscillating between sort of 1% and 2%. And that's become the norm for pension scheme trustees, actuaries and employers. And we've got used to how our schemes look in terms of funding and decision making in that environment. Over 2022, we saw the start of a real rally of these government bond yields, which started to change the picture. But it was when as Paul was alluding to, when the political environment really changed in sort of September time, that government bond yields really took off. And now they're settling at a point where perhaps we're at a bit of a new normal. So we're seeing government bond yields now of about sort of 3 to 4% quite regularly. And if this is settling as the new normal, well, how is that going to affect our pension schemes, and what do we need to be thinking about? I hope everyone liked the reference, the football reference at the top. Well, I think that the two important areas that we're looking at are scheme funding and long-term objectives, which typically for smaller pension schemes tends to be buyout. Because once a small pension scheme gets to a certain stage of maturity, the cost of running that scheme outweighs the benefits of the lower costs of running it on versus sending it to an insurer. So in terms of scheme funding, well, gilt yields increasing by more than 2% in the last year have probably reduced liabilities by perhaps 40% or so. That's a humongous reduction in pension scheme liabilities. And whether you felt the full benefits of that or not will depend on your investment strategy. LDI has worked really well up until now for minimising the losses on the downside. But it does work the other way, of course. If you're well protected and have a higher allocation to matching assets, then you won't have seen the full benefit from the recent rises in gilt yields. And in terms of buyout, well, our buyout positions would have improved even more. Even when you are well hedged on your funding basis, you're not going to be as well hedged on your buyout basis most likely, meaning that as yields rise, your buyout position improves. And we've seen a real dramatic improvement in buyout positions over the last year or so, and it's really changed the landscape for pensions in this country. No longer are we looking at funding levels of sort of 50 or 60% on a buyout basis, with trustees having no real prospect of buying out in the near future. It's a dream that will never happen. During my whole career, pretty much, that's been the theme. But over the last year, that's just changed completely on its head, and now we're seeing schemes with funding levels of sort of 80 or 90%, very commonly, and many above that, looking to buy out right now. And that brings its own challenges, of course. So lots of schemes are now in the position where they're approaching the market and approaching their advisors, and the industry has only got a certain level of capacity. Advisors are stretched with the number of with the amount of work that they need to provide and the advice that they need to give to clients around buyout, and insurers were already operating pretty close to capacity, and now they've got a whole new influx of pension schemes that they need to service, especially going into next year and beyond. So I think we've been saying it for many years, but more as an aspirational aim than a reality. But I think now it really is key that preparing for buyout, if buyout is your long-term objective, and for many schemes it is, then preparing for it right now is the thing to do, whether you're close to buyout or not. And when we say preparing, we mean things like realigning your investment strategy. If you've already got the gains to date that have got you to a position where you're seriously thinking about buyout, then you should be aligning your investment strategy accordingly to lock in those gains. And then it's lots of other preparation tasks like reviewing your benefits, getting a benefit specification drawn up, starting those conversations with insurers and advisors to get slots built in so that when you come to need to approach the market for quotations, then everything's in line and you can do that swiftly as possible. And in terms of what you should be thinking about today, I suppose if you don't already have sight of what your scheme's funding position is today, then go and ask your scheme actuary, most definitely. If your valuation isn't soon or your next funding update isn't soon and you don't know, certainly ask your scheme actuary, because things would have changed dramatically compared to what you were seeing last time there was a funding update. And talk to your investment advisor. As we said, if your position is much better than you thought it was, then de-risking might well be a very good option for you. I sort of focused on trustees mainly, but this slide is for the employers in the room more than anything. So we've seen, as we've talked about, we've seen tremendous rises in gilt yields over the last year or so, and that's been mirrored in the corporate bond markets as well. So corporate bond yields I've seen similar increases, meaning that accounting liabilities, that is your liabilities that you disclose on your balance sheet, would have reduced dramatically. And that's going to just lead to, and that's regardless, I should say, of the way that the scheme is funded. Not every scheme will be funded on a gilts plus basis, although a lot are. And they might not have seen funding level improvements like the rest of the industry has seen. But on your accounting basis, everyone has to use corporate bond yields to derive their discount rate, and that will feed through into your funding position then. And then the final point there is for any employers operating multi-employer schemes, like the LGPS is a very good example, where in the private sector we're talking about travelling towards your buyout objective, so you can discharge benefits and walk away from your obligations. And in the public sector sphere, in sort of like the LGPS schemes and similar, that's called exiting. And those exit costs are derived with reference to gilt yields or low-risk assets. And so, again, that would have changed the picture dramatically from what you were seeing at your last valuation. So that's certainly an area that you should be discussing with the wider fund if you're interested in coming out. And finally, I've focused a lot on defined benefit schemes. Being an actuary, I suppose that's natural. But defined contribution schemes, of course, are affected by all these issues as well, to different degrees and different levels. Typically, we see older members being invested in sort of lifestyle strategies, meaning that as they approach retirement, they come out of growth, sort of equity-type investments and move into bond-type vehicles. And those vehicles would have really had a hit in value over the last year or so as yields have risen. And that should be communicated carefully again to your membership, who might have quite a surprise seeing that the DC pot has fallen so dramatically in value so close to their retirement. Usually that's for a good reason, because you invest in bonds if your intention is to buy annuities afterwards, and the cost of annuities has come down dramatically. We were doing some analysis at the office earlier this week, and I'm thinking that the recent falls of the past year or so in gilt yields have probably increased annuity rates by about 30%. And what I mean by that is you can get 30% more income if you buy an annuity now compared to a year ago. So that's a pension of £13,000 a year instead of £10,000 a year, purely due to timing, which is amazing, really. And begs the question, does that mean that significant improvement in the value of annuities, does that mean that we're going to, added to that, I should say as well, that everyone's a lot more conscious about certainty, costs, living, that sort of thing, and annuities tick that box really nicely. Are those factors going to drive us or lead us towards a position where annuities come back into fashion, replacing the current trend of pension flexibilities and taking cash from your pension pot throughout retirement instead? And that's all I wanted to say. If anyone has any questions, then let me know, or I can take them at the end. Hey.
So to break it down really simply, I think what you said, the government has borrowed a huge amount to get us through COVID. That has led to long-term interest rates increasing, which has then led to a benefit for companies and pensioners with annuity rates going up. So government bonding has actually reduced the cost of long-term pensions for all companies. Is it as simple as that?
No, inevitably, is going to be the answer. Yeah, certainly some of that's true.
Some of it's true.
Some of it's true, of course, yeah. There's a lot of factors driving the gilt markets.
But we have to explain, I'm a trustee, a director trustee, we have to explain to the members what is going on. Now, we can't go into massive complexity, we have to break it down. So how would you describe it simply then for a member of a scheme?
Good question. I suppose simply for a member of a defined benefit scheme, I think the message I would give them is there's a lot going on in the financial markets, and you've probably heard a lot about it, more than you ever have. It's in the news every day. But if you're in a defined benefit scheme, it's not your problem to a certain degree. Your benefits are guaranteed from retirement, and that's the beauty of a defined benefit scheme. It's all the risk and all the worry about the uncertainty of markets and scheme funding is left solely at the employer's door. And as a member, you should be most concerned around, what your pension's going to be from retirement onwards, and that picture hasn't really changed. Of course, they need to consider employer insolvencies and that sort of thing when it comes to the PPF benefits that would be payable, and that might be a good piece of information to communicate to members because whenever you send a summary funding statement out, for example, you need to say, well, this is what would happen in a discontinued sort of scenario. You get PPF benefits and that sort of concern added to the general cost of living concerns that they would have already might be a bit disconcerting, but providing some colour around that and saying, well, the employer's doing really well, these factors are helping the scheme positively in terms of funding, and the certainty of your benefits is increasing, should be a positive message, I would think. And I agree, not going into too much of the complexity.
Thank you, that's very good.